The policy loan is really, like we said, is the engine of infinite banking.
When we are going to the insurance company, we're not saying I'd like to borrow your money, but we're bringing to the table a contractual right that can't be denied. You can borrow almost your entire cash value. The cash value, remember, is the net present value of your future death benefit. What is that future payout worth today?
Nobody has a simple interest loan because at some point in the real world, the interest will always accrue. But it kind of works differently on a whole life insurance policy because it operates like a simple interest loan during the policy year. There's a lot of misinformation out there on these interwebs and on the YouTube channels and everywhere else that calls these simple interest loans, and they're not a straight up simple interest loan. That only exists in 7th grade math class.
Every dollar that goes in is going to principal, and that's very powerful when compared to anywhere else you can invest.
It's your money, so they don't care. They're not going to ask you what you're using it for. If you want to borrow it to loan so that your cousin can get a new van down by the river, then go ahead. There's nothing like getting out of the passenger seat in your financial life and taking control.
Control is freedom.
It's like I'm borrowing from future dead me, which is awesome. Hey, what's up, Ons?
What's going on, Brian? How are you?
Good. How are you?
Good. Just spent all morning dealing with inefficiency and bureaucracy, trying to add my daughter to our continued healthcare plan through the military TRICARE system. We're just using that temporarily, quarter by quarter, until we figure out what we're going to do long term. And it's been a great reminder of how much I hate dealing with the federal government. Probably 10 phone calls today, probably 10 phone calls on Friday, where the same two entities are referring me, saying, this is who you need to talk to. Let me connect you. And they just keep connecting me back and forth. And all the while peppered with appointments at the ID card office, all just to add my daughter into the system, which could just be an email, could be in any other situation, anything else with insurance, with online services. You can just upload a document, it's processed and goes into the system. But the goat rope of trying to do this has been validating as far as my decision to separate from that entity entirely. And I'll try to contain my, people probably can relate to like the phone tree cycle where you're like, no one beneficiary, and you're like yelling and that drives me nuts. But then you add the military and the inefficiency of an entity like that to this phone tree, and I am ready to rampage. So we're going to talk about something better today, though.
Yeah. There's nothing quite like it. The government probably has the highest level of ineptitude of any organization I've ever dealt with. So I feel your pain. I'm glad I'm not feeling it currently at the moment, but pretty aggravating to deal with anything that's beyond a self-service function. And even those usually don't work.
Yep. How are you doing?
I'm doing all right, man. Just been busy plugging away at a whole bunch of work here today, and house full of kids in the summer. It's raining, so it's been loud and wild here today. But all is well.
Cool. Well, today we're going to continue our Under the Hood series, which are just going to be mixed in there throughout. We want to make sure that we're hitting some specific stuff so that as we talk about the philosophy, we talk about the why behind what we're doing. We also want to make sure that you're not listening thinking that sounds cool, but I don't know what you're talking about or how to do it. So you want to cover a little bit of the policy loan, just kind of give it a brief overview before we dive in.
Yeah, so the policy loan is really like we said, is the engine of infinite banking. It's what gives us the possibility of leverage. It's what gives us the possibility of having our dollars work in more than one place at the same time, and creating that velocity of money multiplier that can really enhance our wealth. Policy loans are unlike any other loan that I'm aware of, and they are contractually based. So it's a first line secured creditor access to the capital that you've built, the equity within the policy. And they can be used for anything. So that's what really makes them powerful. They can be used for anything. You borrow against your policy, not for your policy. That's really, really important language that we're going to go more in depth with here. And And that money, and what it allows your money to do is, as we've talked about in prior episodes, is never stop growing, never stop compounding.
Yeah, and I want to emphasize what you said about being the first line creditor there. When you go to the bank and you are trying to take out a loan, you're asking them, I want to borrow your money. May I please do that? And then they have their long process of underwriting and deciding if you're a worthy person to lend to based on a bunch of factors that you probably are all already familiar with, because most people have taken out a loan at some point in their life. But you're saying, can I borrow your money? When we are going to the insurance company, we're not saying I'd like to. I mean, okay, we are saying I'd like to borrow your money, but we're bringing to the table a contractual right that can't be denied, and we're in a sense, now we're going to break this distinction down. We're saying I would like to borrow my money, but against my money, not withdraw it. And so you have the right to walk in the door theoretically and say, I will take my money, please. But we have, because it's a policy loan, we're borrowing from the company. That, again, that's just it's like you're not asking for permission to do this and they're not underwriting you again, et cetera. But I do want to be clear that I'm not misleading, that we're not reducing our principal. We're not borrowing our money and withdrawing it. We're collateralizing it, which we will cover in detail, but just focus on how powerful that is, that you're not walking in and asking for it with a chance of being turned down.
So how much can you borrow?
You can borrow almost your entire cash value. The cash value, remember, is the net present value of your future death benefit. What is that future payout worth today? Whatever that number is, you're going to know your total cash value, and something to the tune of about 97-ish, 98%. I think it depends on the insurer, but almost all of it, save a couple percent, is available for you to borrow against, again, without underwriting, without questions asked.
Yeah, and the purpose of that small percentage that you can't borrow is most companies, this is a general statement and it's gonna vary a little bit, but they're gonna allow you to have access via policy loan to the total amount of your cash value less the interest that would accrue on the next policy anniversary. And what that does is it prevents you from having any kind of lapse because you no longer have any value in the policy in one policy year or one turnover. So yeah, you can pretty much access all of your money, and that is a security measure that's in place to make sure that your policy stays in force. So it's a good thing. It's, some people look at that and think I can't get all of it, and that's a problem, but it's actually a good thing because it prohibits you from letting this, incredible asset falter and fail due to your own mistakes.
Yeah, and if you think about comparing, again, it always compared to what, if you're thinking about, well, maybe you do have access to 100% of the money in your checking account or your savings account, but if you need to go make a purchase, are you going to withdraw? If you have $10,000 in there, you're going to withdraw all 10,000 and just leave the account at empty. There's not many scenarios where that would be the case. And so it's not a loss, because again, the cash value is still there in full. It's just what we can collateralize by borrowing against that has a very small couple percent restriction for the reasons Brian mentioned.
So let's just talk in some general terms, because everybody who takes a loan is always focused on the same sorts of things. So the first thing there you talked about is how much. Well, we talked about how much it's based on the size of your policy versus maybe some other underwriting terms that the bank uses that can often really harm a person. Like when they look at how much you can get a mortgage for, that isn't necessarily how much you can afford. It's how much some underwriter said that they will allow you to take that might destroy you financially. The next thing that most people are thinking about is interest rate. So what can you tell me about the interest rate on these policy loans?
Yeah, so there is a formula that you can go into that the company has for any day that you ask for a loan, of how they would calculate based on larger macroeconomic rates what their loan interest would be that day that you take it out. And so with one of the companies we use, if you log into the portal and see your cash value available to borrow against, you'll see next to it what the interest rate would be if you were to take out a loan today. Once you take out that loan, that is your interest rate for a year. And then on the anniversary, at least with this company, your policy anniversary, it would be changed to the current rate for the next year. Now, that would technically be a variable loan. The rates that they use are going to trail essentially the Fed funds rate, the cost of money in the market. Again, not directly that number, but with a formula that they each use. So it's gonna generally track what the market rate of money is.
Historically, a lot of these policy loans used to have fixed rates. Some of them still do, but they tend to be a little bit higher actually than the variable rates that you get now. Um, and what happened in the past was people would use a system of almost like arbitrage. So people were the interest rates could be as low as maybe 5 or 6%. And I'm talking historically. Let's go back a few decades when you could get a money market or not a money market, a kind of CD at 10, 12%, say in the early 80s. And so what people were doing was they would borrow from against their policy from the insurance company at a fixed rate loan of like 5%, maybe 6%. And then they were putting that money into a CD and getting a much higher rate for arbitrage. So the companies started to realize they had these large volumes of loans against their portfolio that they were getting a low return on. And, people were doing that, getting the returns elsewhere and repaying them at some point because contractually, which we'll talk about in a second, they weren't obligated to repay it right away. Well, the companies got a little bit wise because that what that did was it put a squeeze on dividends, which is also one of the massive benefits here when we're talking infinite banking, is that we want our companies to pay good dividends. So if people are taking advantage of these contractual rights in a way that hurts the company, the dividends have to go down. And so a lot of the companies, they switch to a variable interest rate. That said, they tend to still be better than the market rates. Like you said, the companies we deal with right now, we can get access to money in the neighborhood of 5%. Some companies that are out there are 6%, but I can't get a car loan for less than 7 or a mortgage for less than 7 right now. If you want to get a personal loan, you're looking at double-digit interest. So these are still exceptionally favorable loans to take compared to the market.
Yeah, and we will say it over and over that IBC is not about rate of return, and rates are not the sole focus. Math isn't money, money isn't math. A couple of years ago, that might have not been the case, where rates were super low in the market, and insurance rates were trailing the other way to catch up. So there, it's not the focus, but it is true that having this contractual right allows you to potentially explore that arbitrage opportunity.
Yeah, it can. So I think that's pretty good on the interest rates. What about the obligations to repay loans? Let's talk about that. Is one of the best things that I think we have is our contractual right to treat these. Well, it's not even the way we treat them; they just are an unstructured loan. So how does that work to our benefit?
Yeah, that is huge because we're trying to take back control. We talk about stopping a passenger in your family's financial future. We're all about taking control. You should be in the cockpit like of your financial journey. So control is huge, and having the ability to set the terms of your repayment is invaluable, especially when you compare it to your overall financial picture and different cash flow situations, etc. And this is the big foot stomper. Yes, you can take out a loan. Yes, it is guaranteed to be given to you without underwriting. But those two things alone, or that one factor alone, is powerful enough. But the fact that it's unscheduled is really the jet engine on this thing. And that is because there is no default risk to the company. Typically, an interest rate is going to be at a very basic level comprised of the time value of money and the default risk. So if you think about two people in your life that you might lend money to, you can probably pick someone who you know would return the money. They have a great purpose for it. They're going to invest it, and you have no concerns that you'll get paid back with interest. You can also probably think of another individual where you very likely would not get paid back, or it would take a long time, or they might default, et cetera. And so if there was no default,
that's probably your cousin down by the river. Don't loan him money.
Exactly. And so if there was no default risk for either of them, the only consideration would be the time value of money. If I'm going to give you $10,000 for a year, how much do I need to be compensated for not having that $10,000? That's the time value of money component, but the other one is the default risk. And so why is there no default risk to the company?
Well, they're going to be made whole no matter what, because it is the entire the loan, the side of their portfolio is completely collateralized at all times. It's either collateralized via your cash value. So if you stop paying a premium, they've leveraged or collateralized that cash value, and they're just going to close the policy and keep the cash value, or they're just going to keep that. They're not going to pay you back that cash value. Or in the event that you pass away, which the premiums will stop, they have a death benefit obligation to your beneficiaries. However, if there's an outstanding loan, they're going to reduce the death benefit by that outstanding loan and the interest that has accrued. So they're going to be made whole no matter what. It's a perfect place for them to have to consider, and it's like an investment to the company, and it's a perfect investment because it is always perfectly collateralized. They can't lose. I was gonna say, but going all the way back to the first thing I asked you, and what we were saying is, I want to reiterate that these are unstructured loans, and that means that they're just going to loan you the money, and they're not going to tell you how to repay it. I just want to really simplify that. You are going to come up with your own repayment schedule, and that might be, let's say, for example, you're doing a real estate project. You're gonna invest with somebody for a fix and flip, or you're going to do your own fix and flip, and you want to sit on that loan for 3 to 6 months while you turn the property and then get it listed if you list it and get it sold. Well, then you don't have to pay anything back. The interest is going to accrue, and it's going to accrue and be paid at the end. But you have the flexibility to not have to worry about making repayments on that loan, knowing that in a few months you're going to have a large event, the sale of that house that you're flipping, and then repay the loan in one fell swoop. If you wanted to take a loan for something like a car, you just log into one of the probably millions of calculators online, or an Excel spreadsheet, or you call us and ask, and you only need a couple of the things. You need to know how long you want to take to repay it, what the interest rate is, and what the amount. Any two of those variables, and you can figure out the third variable, and that'll tell you how much to pay every month to pay that off. But you're going to do better than paying it off using one of those calculators, because this is not a standard amortized loan. Another important part about this is, and I will caution to say, it's because I'm kind of going to touch on it a little bit. There's a lot of misinformation out there on these interwebs and on the YouTube channels and everywhere else that calls these simple interest loans, and they're not a straight up simple interest loan. That only exists in 7th grade math class. Nobody has a simple interest loan, because at some point in the real world, the interest will always accrue. But it kind of works differently on a whole life insurance policy, because it operates like a simple interest loan during the policy year. And what I mean is that there's a charge. So when you make a repayment on your policy loan, it's going to be a 100% principal repayment. It's going to pay down all principal. If I make $1,000 payment, it's going to take my loan balance, subtract 1,000 from it. That's my new loan balance. There's no amortized interest on your monthly amount, or whatever mode you're paying it on. And the way that they're going to collect their interest is at the end of the policy year, they're basically going to issue a new policy loan, and the amount of the interest that was calculated through the year. And that policy loan is just going to be tacked onto your other policy loan. So if you paid down a whole bunch of principal, it's just going to roll right into that, the interest at the end of the year. So I think of it as, and it might not even be perfectly appropriate, it's like a simple interest loan that accrues annually. And so it's not a simple interest loan. I just want to make that clear, but it's hard to describe it otherwise, because it kind of works like one for every 1 year chunk.
Right. And compared to, for instance, a mortgage amortization, everyone knows in the first, the front loaded interest of a mortgage, as you pay your monthly payment, every month you pay, the ratio of interest and principal in that payment skews in favor of principal. But in the early years, it's almost entirely interest. If you've had a mortgage and you've paid for 3 or 4 years, you have maybe you have 5% of your total dollars put towards that mortgage have gone to paying down principal. Or a car loan, that ratio is set for 5 years. It's amortized to where every payment is an equal portion interest, equal portion principal. But you pay that car loan for 1 year, and that the percentage that's designated to interest is how much of your total payment has gone to interest and not towards paying down the purchase price of the car. Here, like Brian said, every dollar that goes in is going to principal. And that's very powerful when compared to anywhere else you can invest. When we talk about I want to bring it to kind of a tangible example that you can wrap your mind around if this seems kind of too theoretical of how the company might view this. I'm going to use my actual policy at the moment, my IBC policy has got $1 million death benefit, and I have a $60,000 loan outstanding that I use to invest in some rental properties. I used it as the down payment, and so those are cash flowing right now. The tenant is paying both the mortgage on the rest of it, and I'm paying my policy loan back with the cash surplus. So that's happening right now. If I were to die tomorrow, the company would say to my wife, "Hey, Stacy, we owe you $1 million tax free," because that was the policy that Hans had. However, he asked for 60,000 of it in advance, essentially. Now, it's not, they're not advancing the death benefit, but just to think about it, what we're trying to say here, he already borrowed $60,000 of it, and so he left that loan outstanding. So in a sense, we fronted him 60,000 of that million. He's already got it today, and he's doing things with it. So instead of the $1 million that the policy would give you, because of that outstanding loan, we've already given him 60 of it. We're going to give you 940,000 tax free. Now, as I pay back that loan, I'm chipping away at that loan balance, getting closer and closer to that $1 million that will one day go to her. But just if you think about how the company looks at it, and that hopefully kind of ties a ribbon on conceptualizing that the company knows they'll get paid back.
So yeah, it's super cool. It's like I'm borrowing from future dead me, which is awesome. and what this really means to you, dear listener, is that if you were to go get a car loan at 5% interest and pay it for 5 years, that's what used to be standard. I think now they're moving up to 72 months and everything. And if you did the exact same equivalent loan with your policy loan, because you're paying back 100% principal payments along the way, and that interest is amortizing or capitalizing rather at the end of the year, you're going to pay the loan to the insurance company off much faster, and your money's going to keep compounding, and it's going to cost you less. So it's going to be a more efficient loan than a bank loan that's amortized. And that's what I think the bottom line and why this is beneficial to you. Another awesome thing about these loans is who needs to know about it. So if you do decide to go get a mortgage for something, or you do decide to take a bank loan for something, one of the things they're going to ask you for is all the debts that you have. They want to know your income. They're going to know your assets. They're going to want to know what debts you have. Do you have to report this to them?
No, and therefore it will not be impacting your debt to income ratio.
Yeah. Do you have to? Yeah. Do you have to report this? I'm going to bring this up again to FAFSA. Nope. So if you're applying for college loans for your children, not only does this not account, not only does your cash value not count towards your asset balance, but the loans against it doesn't count for or against you. It's completely secure and confidential, which is awesome on the policy loan side. The next question is, when we talked about having that first right access to this money, what are the stipulations on what we can use the money for?
There are no stipulations, because we are the first line secured creditors. It's our contractual right, and that contractual right comes with no asterisks or use cases that are allowed.
It's your money, so they don't care. They're not going to ask you what you're using it for. If you want to borrow it to loan so that your cousin can get a new van down by the river, then go ahead. They don't care. They're not even going to ask you about his van, his river, what he does in his van.
Yeah, they'll never know. And basically it's as simple as logging into your client portal and requesting it, and they're going to say how much and where does it go, depending on the state, or depending on if you have a co-owner who's a spouse, there might be some additional paperwork that you need to sign. But again, there's no underwriting. The entire process consists of just logging in, saying you want X amount of dollars sent to this bank account, and then the request just processes, and then the money hits your bank account, and you do what you want with it. And then they will never follow up and ask you for a payment, because again, they know they will be repaid one way or another.
Yeah, and some companies do have some slightly different procedures for getting that. Like some of them will give you a cap, let's say $50,000, that you can go through your portal, and then beyond that, you might have to call and send in a form. But it doesn't really get much more challenging. Like, we're starting to work into some first world problems there if we feel like picking up the phone and saying, I want access to this money is too much. But yeah, so that's not a blanket statement, but it's that simple. You log into your portal, you make a phone call, you ask your agent. It's super, super simple.
If you don't want to pick up the phone and make the call, you can do what one of our clients just asked me to do the other day, which is basically put the policy loan paperwork in his inbox. And so we can do that as well. So if we are your agents, then you can just let us know you want to take out a policy loan and we can do it. If we need to call the company, we will. But again, it's very simple.
Very, very simple. No extra forms, no crazy amounts of wondering what you ate for lunch or why this money was transferred from this account or the other in the last month. And none of those questions exist, which just makes it absolutely awesome to know how easy it is to get a loan. People, one of the questions we always get is when somebody reads Becoming Your Own Banker by Nelson Nash, they often say, like, so when I'm repaying these loans, that's going to me, right? I'm paying this interest. Where's that going? That goes to my policy. We get that. That's the question people ask. How's it actually work?
Yeah, you're taking a loan from the insurance company's general account or their pool of money, which includes all of the premiums that come in, all of the investment returns, and then net from the costs to run the company and the liabilities paid out, i.e. the death benefits. So that pool of money, which they have to grow from a smaller amount, aka your total premium input, to a larger amount, aka your death benefit one day, they are making those investments in different things, but they're very conservative with their overall portfolio. I think we've talked about that before. We'll talk about it again, but you're borrowing from them and they are saying, hey, your $70,000 cash value, we're not going to touch it. We're going to let it grow. It's guaranteed contractually to grow. We're going to let it be uninterrupted. We are going to make a claim on that if you don't pay us and you die with this loan outstanding, but we're not going to interrupt that growth. So when we repay the policy loan, it's not going to our cash value. It's not going to our policy in any direct way. It's going back to the company because it is an investment for them. And like we mentioned, as we've discussed, it is the safest investment for them because there is no chance of default on it.
So I'm going to pick it up there. In Nelson's book, he often talks about paying yourself back at a higher interest rate than what the policy loan charges or what the company charges. And the idea behind that is that on the market, if I go out to Wells Fargo right now and I try to get a car loan, we'll just stick with a car loan. They might charge me 8% interest, but I have access to money via the insurance company at 5%. So Nelson's saying that I'm going to leverage my capital at 5%. Is my capital worth less to me than Wells Fargo's capital? Should I treat my capital worse than I would treat Wells Fargo's capital? So if I was going to, or before I started learning this process of becoming my own banker, if I was going to go to Wells Fargo to get a loan, and I would have paid them 8%, which is what I would have had to do if I didn't have cash to pay, shouldn't my money also be worth 8%, even if I have access to it at 5%? So what he advocated for was pay yourself back at the market rate. Find out what it's worth on the market and pay it back at 8%. Now, one of two things is going to happen. If you set up an amortized, schedule to repay your loan and you're paying it back at 8%, you're going to end up paying your loan off early. But Nelson said, be an honest banker. Pay that full loan, even though the loan is now paid off to the insurance company. It's gone. All your capital is back, or all the access to your capital is back. But maybe you paid it off out of the 60-month car loan in 57 months. Make the next 3 payments at 8%. Those 3 payments would be used to buy additional paid up insurance, PUAs. And that's going to expand your capital base. It's going to expand your death benefit. It's going to expand future access to capital. The other way that could work is if you paid it back at 5%, you could take the extra 3% and every single month make a little addition to paid up additions. So where people get the misconception is that you're paying yourself back interest, and you're not. You're paying the company back the baseline interest that they charge. Some of that is going to come to you in the form of a dividend, but the extra interest you pay is going to be used to buy paid up additions and expand your system.
And that expanding your system, expanding your policy in this conversation is understandably where people can misinterpret that, because by paying it back more aggressively than the terms that, like Brian said, if you're paying back from those last 3 months that you technically don't have to because the loan is paid off, but you put that money into your system, you are expanding your system by purchasing additional insurance. But everything up to that 57-month point was just paying back the loan. And again, it's not that the interest you're paying is going into your policy and growing it that way. What he means when he says your policy grows by paying it back aggressively is that you pay it off sooner, get to zero on the loan balance, and then put the remaining money into your policy. It's a very important distinction, and it's something that's in the kind of TikTok flashy marketing of IBC. You'll see something like, get rich by buying cars under the kind of the misleading guidance that by paying back a policy loan, you are increasing the size of your policy itself through that very payment, which is not true.
Yeah, you cannot get rich buying cars. I mean, unless you're doing some kind of crazy car arbitrage and you're buying in the luxury market and maybe it goes up in value. But for the general purpose, people who buy cars to drive, you are not going to get rich doing it. You will not improve your system just by taking loans. It does not grow your system alone. It's the way you pay them back. If you pay back an overage, and then if you use those loans to do something that's going to buy a cash flowing asset, that's how you can grow your wealth. But you can't do it just by buying depreciating assets like a car. So when you hear that out there, it's not right. Recognize that. Look a little deeper is what is my suggestion to you. But another question that comes up all the time, Hans, based on what you just said, is we're going to pay back until that loan's completely paid off, and then we're going to buy more paid up additions. Well, what if I've paid all my paid up additions for the year?
Then, so yeah, if you don't have any more room for PUA, you're not going to put additional capital in that could mech the policy, which is something that we'll talk about ad nauseum in future episodes. But you can put that money into what's called a premium deposit fund, where the money is attached to it's put into an account that's basically like an attached savings account, which is earmarked for premium. Or you could just keep that in your personal system, earmarked for premium to put into the next policy year, just saving forward into the future. Is that where you're going with that?
Yeah, you could do that. Or I think even at that, if you're paying all of your premiums, you're maxing out all of your paid up additions, you're paying back your loans, and now you're completely out of debt and within your own policy. I'm going to call it debt. And all your loans are now paid off and you're just accumulating that cash. This might be a good time to consider expanding your system.
Sure.
It sounds like you've got a capital surplus in your life, so you might want to consider taking out another policy or finding another way to make that money work for you at this point.
Yeah, and we talk about to bring this to how you can use this towards efficient, not only like numbers wise, making your purchases more efficient, and like say a car, for instance. Maybe you could get a car loan on the market for 5% or 4%, and the policy loan rate is 5%. But let's think about the three of the most common ways, or the two common ways that people purchase cars. And then, this is kind of a brief overview of what Nelson talks about in Becoming Your Own Banker. He goes into a lot more detail, but briefly, if you save your cash to buy a car and then you buy the car, you now have a car and no cash. It was a one-way use of that cash. If you borrow from the bank or from the lender, the dealer, you have the car and a loan for, say, instead of $30,000 cash, you might be paying back $35,000 through this car loan. But then when it's paid up, you have a car and no cash. Again, a one-way use of that money that went in. When we talk about the multiplication effect, that's where the power of this comes in, because once I pay back that loan, my principal, my cash value continue to grow the whole time, and I can access it again and again and again. Now, if my daughter wants to come to me in, say, 15 years to buy a car, she can do either of those first two methods. But if she takes a policy loan from me and I make her pay me back with interest, I give her the same terms as the dealership. I say, all right, yeah, you can borrow $30,000 from me, and you're going to pay me back the $35,000 instead of the dealer. Well, that might seem like a break even, just a wash for her. But what's happening, if we think back to what I said about if I die and leave a loan outstanding, the company says we already fronted him that $60,000, so you get the rest after we get made whole. Well, in the case of the car loan, as my daughter pays me back and I pay back that policy loan, I am releasing that lien on a portion of the cash value. And so all she's doing is making her future estate more whole, because when she pays back that loan, that $1 million death benefit now goes to my wife and my daughters. That's part of the family estate that is made whole there. And so in a sense, that's how this can be used for generational wealth, because rather than that interest going to the car company, the interest in this case is going to the insurance company, but in the process of doing so, it's releasing the lien on her own future estate. And that's why it's so powerful.
Yeah, so it's not that you can get rich buying cars, but you can definitely do it much more efficiently in a way that is within your own wealth system.
Yeah, and we each have an example of a friend and client where a use case for this. I'll talk to to my friend who is currently under contract on a house at the moment, and without really giving too many details, let's just say he's at the bank at this moment as we're recording, trying to get a loan finalized. He's sent me about an 8-page paper that he wrote justifying, because this is an $8 million house, and he's bringing about $3.5 million to the table. So his loan to value is close to 50%. He's saying, "Hey, I'm going to bring half the purchase price of this house to the table up front. I just want you to fund the remaining 5.5 million." And he is having a nightmare of a time getting, it's all the way up to the president of the bank, getting them to buy this loan because of cash flow. They're scrutinizing every single thing, even though the financial picture as a whole is really, really strong. It's just they have to get money into the right spots to appear that, to make the balance sheet look the way that the bank wants to see it. So he reached out to me and said, "Hey, I just need to get money in accounts so that I can present our actual financial picture." Because again, they're not looking at his cash value. He's got a lot of cash value, but it doesn't show up on any of these statements. And so he's going to take out a policy loan, which we're working on right now. He called me and said, "Hey, can you make this happen?" And so he's taking out a policy loan with no questions asked. And so the ability to access this capital without underwriting, without questions asked, while you are in the midst of dealing with what we talked about earlier, where what about this transaction for $30 that came from this account? Can we get the 3 months of statements from this account so we can see where this money's blah, blah, blah. Like that whole process that you've been through, if you've got taken out a mortgage, he's going through that process, but on steroids. And so the ability to get a 6-figure policy loan put into his account in a couple of days without any questions asked is a testament to the value of control. And you have a friend and client who is in a similar situation. If you want to cover a little bit about the utility of policy loans for him and how he could use it in his business.
Yeah, actually, we talked about this in a prior episode too, where a friend of mine was just trying to buy a portfolio of properties, and same thing, having a difficult time, even though has massive cash flow on his properties on his entire portfolio. And at the time, he ended up getting it all worked out. But I remember when we first spoke about it, he was having a heck of a time getting access to the loan to buy this large, already cash flowing portfolio of properties that was going to continue to largely cash flow. And none of that mattered because the banks are tightening up. And who makes the rules? The banker makes the rules. It's the golden rule. He who has the gold makes the rules. And so we want to have the gold. So that's the beauty of storing capital in these policies. It's the beauty of infinite banking is we get to make the rules. The banker always makes the rules.
Yep. Yeah, it's just a level of control, and that gets back to, it's not about trying to nickel and dime a percent of arbitrage where you're figuring out the spread you can make by using a HELOC versus a policy. You can do that if you want, but again, the power of control can't really be put into a percent rate of return number. But having options and having the ability to access that capital without questions asked, while simultaneously not diminishing the capital, the principal itself, is a huge tool, the Swiss Army knife that you should have in your toolkit, because it serves you on many fronts beyond just, it's not simply a loan like other options that you're familiar with.
Yep. There's nothing like getting out of the passenger seat in your financial life and taking control.
Indeed.
Well, you got anything else you want to say on policy loans?
No, I think that's a good overview. We're going to talk about them all the time in coming episodes. It's integral to what we are trying to do. And so we will reference them over and over and over, but we wanted to give a little bit more of a background and some mechanics on why these are so powerful, so that you understand that as we talk about it moving forward.
Yeah, they're absolutely awesome. It's super powerful, super easy to do, and super just the fact that you can be in this much control is gives you a lot of confidence in making any kind of financial moves in your life, or taking any kind of risks, or just going through any turbulent seasons of life. and having access to these loans and the control of how we use them, nothing can speak to the security of that.
Yep. Yeah, it's control is freedom.
Yep. All right, man. We'll do it again next week.
All right. See you, man.